Nobody has touched more aspects of the self-storage industry, from tech to owning facilities, brokerage to third-party management. Today on Stories Behind the Door, we have the CEO of Argus Storage Advisors, Ben Vestal. Excited to be live on LinkedIn. Thanks for joining us. And I'm going to get to the guy to my right in a second. Really excited that he's taken the time to join us with all he has going on in his life. Before I go there, I'm going to give a shout out to my sponsors, Kiwi 2 Construction. They've been doing steel in the self-storage, small bay flex boat and RV space for 30 plus years. Wayne Woolsey and his crew, an incredible team. People that have used them have nothing but great things to say. So if you're in any need of steel on a project, reach out to Kiwi 2 Construction at kiwiconstruction.com. And I'm going to take this down and get right into it now with Ben Vestal, CEO of Argus Storage Advisors. Usually I could talk pretty well. My tongue is tied today. Ben, first of all, thanks for joining us. Big news, obviously, with Argus and SmartStop, and we're going to get to that during the course. But I start this podcast with the same question every time. Storage is such a niche industry. I have yet to meet anyone that wasn't born into the industry that said they set out to get into it. So I want to hear the story of how Ben Vestal found himself so prominent in the self-storage space.
Thanks, Thaddeus. Thanks for having me today. I guess I got in the business because I used to be an office building broker, did office property management, leasing, and I actually rented space to the founder of Argus, Mike McEwen, and moved him over into one of our buildings, did a couple deals with him. And then I was fortunate enough one day to get an invite to the Avalanche game, and over a napkin and a beer and a hot dog, we made a deal for me to buy into the company. And 22 years later, I'm the man and own the company. So that's how I got into space.
You've been involved in so many different aspects of the self-storage industry, obviously doing brokerage with the storage advisor side of it. You've had tech in the industry that you've been involved in, owned facilities, and obviously we had the recent transaction with the third-party management side of Argus. What part of that's most fun for you?
It's hard to say. They all have their challenges and their successes. I enjoy actually every part of it. I think, it really speaks to the quality of the people in the industry. I really enjoy working with everybody in the space. They've been super nice to me and super helpful along the way. Everybody from the large operators, the owners, the REITs, the tech guys, the Kiwi construction guys that you mentioned are great. I mean, everybody in the industry has been just fantastic to me, and I feel very fortunate that I was given the opportunity to work here. So, at the end of the day, I enjoy all aspects of it. I will say that the brokerage still thrills me. I enjoy the chase and figuring out the more complicated deals. But I enjoyed the management. I still am involved with the management with my new venture with SmartStop. We've been involved with selfstorage.com over the years and the guys at Sparefoot. So I've really worked on a lot of different angles. I've owned some properties over the years, and it's really just been a great run, but I've really enjoyed just every step along the way.
I have like 10 questions out of that answer that I want to ask. We're going to get to the SmartStop deal. I want to talk to you about where you see tech going in this industry, because that's obviously at the forefront of a lot of things. I'm going to ask a little bit about some of the changes you've seen on the ownership side of it. And of course, brokerage is in the news right now because we kind of had a lull in acquisitions for a couple of years. And you want to pick your brain about what you're seeing on that side of it. Before I do that, this is a question I bring up a lot. I didn't get into storage until 2021. I was 47, 48 years old, going on 48 years old. I'm kind of jealous of folks that have spent 20 plus years in this industry. What is it about self-storage that people are just so generous and so kind with their time? Do you have any theories as to why that is?
I don't know if I have any theories. I think it starts with the fact that, nobody set out and was like, I'm going to be a self-storage guy. It's not something when you go to a local elementary school and you do, take your dad to work and you ask everybody, what do you want to be when you grow up? Very few people, if anybody, says, I want to be in the self-storage business. So I think you end up in it for a number of reasons. You see the product type, you understand that it's a simpler product type than maybe office or industrial or retail. But once you start peeling back the onion, you realize there's a lot of complexities there. And I think for the curious business entrepreneurs, there's just a lot of opportunity in the space. And I think the people in the industry really see it as, if we work together, we'll all succeed together. And I think that's just a great mantra and the way that the people approach their business and approach the industry has really, helped everybody be successful.
I'm interested to know, obviously you're in the Denver area, you were in the commercial space before you got into self-storage. Is that a type of a camaraderie and a type of personal interaction you saw in that space before you got into storage?
I was in the commercial institutional office building space. It's much more institutionalized. And I will say we have seen some of the institutionalization and maturity of the self-storage industry change over the last 20 years. But there's certainly, as the industry matures and becomes more institutionalized, there will be less and less, camaraderie, for the lack of a better term, or just information sharing. I think once you start institutionalizing an industry, the entrepreneurs, still share among themselves, but I think the institutions hold it much more close to the vest.
This opens up the logical next question, which is obviously you've been involved in this industry for a couple decades, and what it looks like today from an ownership standpoint is vastly different than what it looked like in the early 2000s. What has brought that advent on? What has changed? We were just talking to Noah Starr from Tract IQ last week, and like 35% of the stores that are 40,000 square feet or bigger are now owned by the REITs, which is hard to fathom. This is always kind of the mom and pop asset class. How has that changed the industry over the last 20 years in your view?
It has changed the industry. Consolidation continues to be a major component of the industry. I don't really see that slowing down. And really it's because, we have a tremendous business model. Our month-to-month leasing strategy and just our business to consumer is really a unique type of business. Low capital expenditures has really drawn a lot of the institutionals and more institutional equity into the space. And I don't see that slowing down. I do think that there still are opportunities for entrepreneurs and individual owners to participate in the space in major markets and in secondary markets. And we're seeing that today. A lot of, individual owner operators and entrepreneurs are still finding value in the self-storage space and are able to kind of take on maybe some projects that the larger operators just aren't willing to do or don't see the value in them today. But, I do see a lot of, because of my brokerage business, focusing in that $1 to $15 million asset, we sell a lot of deals to individual owner operators, partnership groups, syndication groups, and a lot of them are making really great buys today. And I think the future is bright for them, especially as we start to see operational fundamentals firm up over the next couple of years.
Two questions I want to ask out of that. And the first one I'm going to start with is, where is that opportunity? Because, Public just did their third quarter earnings, $600 million in cash after paying their dividends and expenses. Extra just raised $800 million. SmartStop, your partner on the third party side, they just pulled $350 million, 500 million Canadian in bonds at 4%. From a high level view, it's hard to see where that opportunity exists for somebody, as a sole investor. Maybe you're going and getting bank debt at 6.5%. What type of facilities are you seeing that opportunity for the smaller investor getting into storage?
The smaller investors are finding opportunity in self-storage deals that maybe are a little rough around the edges on the go in, that they have, an industrial or retail component with them as well. The larger operators, the Public Storages, the Extra Spaces, the SmartStops, they look for mostly self-storage deals, properties that are 90-95% self-storage revenue, and they prefer 100%. So, I think that's a tremendous opportunity. Any kind of, hybrid deal, I think is really attractive to the independent operators, as well as just older properties. I think a lot of older properties that have been owner operated for a long period of time, might need some capital improvements that the larger operators just aren't willing to spend the time to figure out and solve. And I think if you do that, we're a big believer that the tenant, chooses the facility because it's clean, safe, and friendly. And if you can provide a clean, safe, and friendly environment for storage customers, I think that you'll find that, a local operator can do just as well as the large operators today. Especially if they choose to partner with a SmartStop or any of the third parties. I think that's the other thing that's really changed is, the third party management platforms that are out there today are really inviting everybody to participate in the space from an equity side. And that can be good and bad. I think that there's a lot of positives and there are some negatives to it as well.
You just keep making this easy for me with the transitions. You're giving me my next questions. And I want to talk a little bit about third party. Obviously, the Argus transaction with SmartStop, we'll get into the details of that as we go along. But I'm interested to see what you've seen in that space. It seems from afar, somebody who's not involved in third party management, that there's more and more people getting into that in the storage space. And from what I hear from the people I talk to, people do like yourself, who very respected from the people I know that have used you folks in their stores. There's some options there and some good options. It's not just, go hire public or go hire extra. There's some other people in the space that are providing really good service to owners and allowing them not have to manage it themselves.
Yeah, I mean, the third party business has really, taken off over the last decade. I got in the business 13 or 14 years ago because I saw an opportunity where there really wasn't a non-REIT type of opportunity there. However, everybody should realize, not all management companies are created equal. And I think that that's very, very important that everybody understands that. And I think that there's a lot of technology based management companies that are kind of, navigating some uncharted territories out there today. I don't think technology has really produced the results that everybody thought it was going to produce. But it is getting better. And I think sooner or later we will get there, but it takes much longer than people think. And I think, I did the deal with SmartStop simply because I thought it was the right time for my clients and my people to really take it to the next level. I do think that there's a tremendous opportunity for self-storage, third-party management companies to create value for owners, but not just the REIT type of properties, the secondary and tertiary properties, the smaller properties. And I also believe that, the standardization of third-party management has really taken hold with Extra Space and CubeSmart dominating. If you want an Extra Space managed facility, you got to brand it that. You got to use all their systems, which it's a good fit for certain types of properties. But there are certain types of properties that need a little bit more of an entrepreneurial approach, whether it be more of a legacy style deal where they keep their name, but they're powered by our systems, or a complete white label out there. I think that there's a lot of people that are fiercely passionate about their brand. And I think that there's some value to that, especially in kind of the secondary and tertiary markets. But I can tell you, we manage a lot of stuff in the major markets in Denver, Dallas, Phoenix, Sacramento, where we do very, very well with independent brands of people that have, 3 to 15 sites in those markets. And I do think, coming out of the COVID kind of era, I do think that there's a push to kind of shop local. People want to support locally owned and operated facilities, and I think that that's really where we're going to try to focus our efforts is really providing that service to the entrepreneurial owner that understands that there's value in being a local owner and operator.
Again, so many questions that you're bringing up. I'm going to go back because we talked offline a little bit about the birth of Argus and the management side of it. And it was an interesting story. So I'd love you to share with me how this even came about, how you ended up finding yourself in the third party management business.
Yeah, it's kind of a small world. I got into I bought into Argus in 2004 because I really saw some opportunities to be a broker in the space. And I thought that there was a lot of opportunity for me to represent independent owners that wanted to sell their facility and really create some value for them. However, through that process, I lived through the great financial crisis. Obviously, transaction velocity was a little slow during that time. And, it gave me some extra bandwidth so I could look at kind of other opportunities to stabilize the income. And I was good friends with Noah Springer and Jim Stevens at the time at Extra Space. They came to Denver to support me and in the Colorado Self-Storage Association. And they were starting their third-party management business at that time. And they knew that I had a background in property management. And they said, there's going to be this opportunity for all these properties that don't want to brand on Extra Space or don't want to, maybe that they're not the big enough to support our expense load. So, they kind of put that idea in my mind. And then Jim Stevens actually called me a week or two later and said, I actually know a guy that you might want to talk to about his business. His name was Mel Holsinger. Turns out that I had bought a small facility here in Denver that was managed by Mel, and he didn't really want to manage it for me, but he had a young guy at the time named Corey Hansen that's about my age. And, me and Corey hit it off and we became partners. We ended up buying Mel out and creating Argus Professional Storage Management, which today is, one of the larger independent facility management companies. I think we had 240 or 230 facilities when we did our deal with SmartStop, and we've really grown that business. Really upgraded our tech stack and learned how to be better by listening to our customers and listening to the industry. But I have to tell you, it kind of goes back to how everybody helps everybody in this business. I would not have had that opportunity or been successful in the third party management business if I didn't have the support of the Extra Spaces, the Cube Smarts, the Public Storages, the Storage Marts, the large operators that have been in this business much longer than me. They really helped me and guided me and really allowed me to not make so many mistakes. You always make some mistakes as an entrepreneur when you start a business. But I think, their guidance along with, I was really fortunate. I had great mentors in Mike McEwen and Mel Holsinger, two guys that have been in the business a long time, 30 plus years, that they really kind of, they really looked out for me and Corey and helped us kind of cultivate that business over the last 15 years to where it is today.
All right, I've been kind of putting this off, but I'm going to ask the question
Yeah.
now. The SmartStop merger or the acquisition, I guess it's called, however you want to term that.
Yeah.
You're obviously still involved in it. It was a pretty substantial deal. I mean, the numbers jumped out at me. I think 23 million in cash was what was reported, another 11 million in stock based on the price at the time. What prompted you to want to do that? And I know you've kind of answered a little bit. You felt like it
Yeah.
was time, but what about now made it the time to make that decision?
I think it's no secret that we're dealing with some operational headwinds in our business. And, whenever you go through a little bit tougher operational time, it really it makes you step back and say, hey, how can we do better? Right. And we need, I felt very, very uh I felt very responsible for the results of our client stores. When somebody gives you the third party management of their store, that they're entrusting you with a lot of times that their life savings are their biggest investment. And I felt very, very responsible to be able to develop and deliver, top notch results. And we were delivering very, very good results. But, I knew Michael back before I was in the self storage business. I sold him office buildings and was involved with some of those deals. And I can tell you, he's an entrepreneur at heart. He came to me and said, hey, I'm investing in tech. Here are all these cool systems that I think are really going to allow us to provide very, very good results for our investors. And I think you have a very unique platform. And so I think it really, the tougher operating environment today really, brought to the forefront of things that we could do better for our clients. Now, bear in mind, I think we were providing and producing, industry leading results prior to this, but I really believe the partnership between SmartStop and APSM is going to lead to really a game changing type of environment. Because Michael's an entrepreneur at heart, he understands the self storage owners. He's not a Wall Street guy by nature. I know he is now. He's a CEO of a publicly traded company. But, Michael started several businesses in his career, and so have I. So, we can resonate and relate with self storage owners much better than guys that have just grown up in an institutional environment. And I think, the owners are going to see value in our optionality throughout our platform.
Something I'm hoping that this industry maintains. Obviously, Noah Springer was on the podcast a few weeks ago. What an amazing story he has, and to hear him the way he helped you and Jim Stevens and H. Michael Schwartz. Hoping that level of camaraderie and willingness to help other people stays in the industry, even as we start to institutionalize more. Awesome story. You mentioned tech, and you mentioned kind of what we thought it might do versus what it's actually done to this point. Take me through that a little bit. Going back a few years ago, where you thought tech might take the self storage industry versus where it's actually, been important in the evolution of managing facilities, and then maybe what you see coming down the pike over the next 5-10 years.
Yeah, 20 years ago when I got in the space, kiosks were just becoming, kind of the hot topic. And I kind of think that that's where everybody thought the market was going to go. That's back in the day when you still went to the ATM to get cash out to go to dinner and stuff. So it's a little bit different time. And at the end of the day, I've seen tech really evolve here, starting out with the kiosks and then to the mobile apps and then the ability to do online rentals to today, I can tell you we're using full AI systems to tell us when we should and shouldn't staff our stores. All the way from looking at how many times gate codes are used, when the rental activity is going to be, the revenue management systems. We're renting more than half our units online today, and it's growing. And I can tell you, we don't not have any kiosks anymore. We have some stores that have kiosks, but they're not operational, and those those really served a purpose, and they really got people thinking outside the box. Right? There's been a lot of guys, the Red Dot guys come to mind, the SROA guys come to mind, the KO guys come to mind. There's a lot of entrepreneurial, tech-driven companies in the space, and I think that they're going to continue to get better and better. However, I do think it is changing, and I think Public Storage has really led the way. They're running a lot of their stores remotely today, using their website as a kiosk. And I can tell you, everything from our revenue management to geofencing and the where we're advertising to using just an overall AI driven decision making system is really where I think the industry is going. I think it's going to get better. However, I do want to say that I'm probably a little old school. I still like having people on site. I believe that people want to interact with a site manager. I think that the site is cleaner and more efficient when there is a site manager on site. However, I do think having them there at the right times is critical. And so I think that the hours of operation where a store is staffed is really going to generally change over the next several years, because I think AI is giving us the data and the ability to analyze that and allow us to staff the stores more appropriately.
Fascinating and interesting conversation there around tech. And obviously we've seen this shift where, especially in more tertiary markets, where folks are going to fully remote management. And I was going to ask that question next. You sort of answered it. um, I guess I'll ask it in a way of like, are there stores where having nobody on site is going to be necessary in order to keep it feasible economically, versus obviously in a major market like Denver, or I'm outside of Philadelphia, New York, where you're always going to have at least some human presence there? How do you see that playing out, especially as guys our age, Gen X and baby boomers above us, start aging out of the major users, and we
Yeah.
start seeing more millennials and Gen Z, if you believe the statistics, using the facilities at a much higher rate than those of us that are a little longer in the tooth.
Yeah, I think that is, I think you hit it on the head. I do think our demographics of our customers are changing, and we're going to have to change with them to make sure that we're providing the service that they expect and shop and interacting with them in the way that they want to be interacted with, which is not necessarily having a site manager sit behind the desk 40 hours a week. I do believe that there will always be some human component to self storage management, because I do believe the stores that have people regularly on site and interacting with the customers create a better customer experience. The facility is cleaner, and I think overall the facility will do better. And if you think about that, we've done a lot of beta testing and run stores totally unmanned. We've done the hub and spoke thing, and we have fully manned stores still today. So I can tell you, we're probably a hybrid of some sort of that. But I would tell you, I think that overall, self storage is going to continue to have people on site. I just think we're going to be there at different hours. We're going to be more selective when we meet with our clients, and our clients are going to like that better. They're not requiring the owner to, or the manager to, sit behind the desk. But I will tell you, we all know that sometimes tenants leave trash in the drive aisles or leave trash in the hallways, and I think that having somebody on site being able to react to that very quickly will lead to a better customer experience. I think that having your site manager participate in the maintenance of the facility allows them to take more ownership of that facility and understand who their clients are. Even though we might be interacting them at different hours, maybe we're open from 4 to 8 or 4 to 9 at night, and we're not open from 10 to 6 anymore. Maybe we're open on the weekends and are closed Monday, Wednesday, and Friday or something. Every store is going to be a little bit different, but I do also think that even if the tenant rents online, and pays rent online, it's good for them to talk to an owner. It makes them feel good about the facility being well maintained, high security levels, and just creates a better personal experience. So we'll focus on that.
I'm going to give you some flowers here. I was out in Denver with Barry, my boss at S3 Partners, who you've been on the Colorado SSA board with for many, many years. And we're going to transition to a question about that, but went to a store that you folks manage that still has an apartment upstairs that the managers
Well,
live on site. And little thing, the woman who manages the store has flowers outside the office that she plants all the time, and they were in bloom when I'm on the store. And so, speaking to that point of like, of course I'm not a customer, I live in New Jersey, and but I can only imagine a customer comes to that facility and there's flowers outside the office. Like, that little thing is going to make a difference in your experience when you go visit a facility.
Yeah, I think that the little things matter, right? The devil's always in the details, and I think having on-site managers is obviously being phased out. I don't think people are building facilities with on-site management apartments anymore. But there's the time and place for those type of facilities, and if we have an older facility that has a residence, we'll use it. The municipalities and the legislation around resident managers have made it tougher and tougher to have resident
Yeah.
managers. However, you just got to do it right, treat your people right, and make sure you spend a lot of time in the hiring process to make sure you have the right people living on site. And we've had great success with it. But I will say, we are moving. The whole industry is moving. When you build a new facility, very rarely today do you see an apartment
It's
on
hard to
site.
pencil it when you got a 2,000 square feet not collecting rent above and beyond the normal office these days. You got to get tight there. I'm going to transition into the Colorado SSA. Obviously, you've been on the board of the SSA for a long
Sure.
time and keeping an eye on things nationally. California just had SB 709 that got passed. It didn't turn out to be a rate cap bill. It turned out to be a disclosure bill. New York City's got a bill that keeps going in front of the legislature, the city council, year after year, that's proposing a 2% cap on rates. How important is that involvement in your state SSA and for other people in the industry to get involved and be aware and stay abreast of what's happening in the industry?
I mean, I think it's tremendously important. I think that for the first time in my 20 some year career here in self storage, we're seeing legislation in many states that it would really hinder the way we operate our business and is threatening the overall business process that we follow. Whether it's rent control, whether it's a junk fee bill, whether it's just a disclosure bill, or some change to the lien law sales. I can tell you there's a lot of things that are going on in there, and everybody wants to point the finger at large operators like ourselves. The public storage is the extra spaces because of our ECRIs and all this stuff that are happening there. But everybody's running their business uh, to benefit themselves and to make sure they're providing a good service to their clients. And I can tell you, I think we need to really think about how we're pricing units today, how we're treating our customers, how we're responding to negative reviews online, and trying to minimize those because, Joe Schoen, I think at the SSA had a good point is that, the real judge and jury of our industry is our customers. And we want to make sure that they have good experiences through and through. And I think that's really what has led us to success for the last 25 years, and it will lead to our success in the future. And I firmly believe that the people that are running self storage facilities are in generally good people that enjoy their doing business with their tenants and will treat them and do treat them well. So I think overall it's very, very important to be involved with your SSA because I think one or two bad situations could lead to meaningful changes in the laws that we have to follow. And I think if you stay involved and stay proactive, educating the legislation on how we do our business, the service that we provide to the community, and the value that we provide to the community, I think that everybody's going to understand that, we are a necessity for our community to operate efficiently, especially with the cost of housing rising. We can provide a lot of solutions for folks.
I think your point is so well taken. And SB 709 was brought by Senator Menjivar in California. It was her grandmother that had a bad experience at a store that led to that legislation being. There was one person. Same thing in New York City. It was one city council person's family member having a negative experience. So just keeping an eye on those things so important. Crazy as it sounds, we're coming up on 30 minutes and I want to honor your time and honor the viewers' time. I do have one more thing I want to pick your brain out. You
Sure.
talked about that brokerage side of it and how that piece of it is really exciting for you. No surprise that it's been a challenging couple years coming out of post COVID and the interest rate hikes in 2022 and sort of slowed down the velocity of the acquisitions market. Of course, 2020 to 2022 was sort of crazy. Talk to me about where we're at in this cycle and what you see, what you've seen in the last half of 2025 going into 2026, how you're thinking on the transaction side.
That's a great question. Our transaction business is where our roots are. It's the majority of our business. And I would just tell you, 2024, kind of looking back, to last year, was really slow at the beginning, and I think it was a shock to the rising interest rates and just overall cost of capital changing. As we headed into the second half of 24, we started to build a little bit of momentum, and that momentum slowly built in 2025. 2025 is going to be meaningfully better from a transactional side for us. And I think 2026 is going to continue to get better, as I think that there's the bit in the ass between the buyer and seller getting closer and closer. The sellers becoming more realistic on the valuation of their facilities, and the buyers are getting more realistic on what the facilities are actually worth. And I think that that's largely due to the fact that we have historical data now for 12, 24 months of kind of the new reality coming out of COVID. We've had much less seasonality, kind of a slower rental season the last couple of years. But overall, I think that the good news is the debt markets have remained pretty stable. I know that we're not getting 2 and 3% interest rates anymore, but last time I checked, we're getting debt in the mid fives for self storage facilities, and historically that's a pretty good loan. I think everybody needs to keep perspective in the fact that if you look historically, a 5.5, even a 6% loan is pretty good. Cap rates are still lower than they should be. So for sellers, I can tell you we're still achieving valuations that I think are probably more aggressive than they should be considering the cost of capital. And I think that that's really the buyers leaning into operating fundamentals improvements. They feel like, that we have some depressed operating fundamentals right now. And I think that it is going to get better as we start to see the housing market improve. But most importantly, the other thing that I think everybody needs to pay attention to is new supply. I don't think people are realistic about the new supply that is actually being built, and I think that that is hurting our business. New supply has always been the Achilles heel of self storage, and I saw Yardi came out with a new report saying that the development pipeline isn't contracting as fast as everybody thought it was. And to kind of give you some perspective, I think historically we've sold a dozen or more self storage facilities, and this year we've sold more than 25 development sites. So we're seeing a lot of transactions there. So as we see the market come back, and as we see the financing market continue to stabilize and get more aggressive, we are going to see a lot of new facilities come out of the ground. And I think that we just got to be responsible on where we build. Overbuilding doesn't help anybody.
On the one hand, that's exciting news for me as S3 Partners makes their business building new facilities. On the flip side of it, I go on a soapbox all the time on my other podcast, the Self Storage Report. Irresponsible development is the most challenging threat I think that we face. And I think 2,700 facilities that came online in 23, 24, not necessarily leasing up to pro forma, to say the very least. Would love to see that, as an industry. And I guess I'll ask you this because you're in a unique position to answer it. How do we make sure that people aren't developing in a place that doesn't need new supply?
I think you got to I think there needs to be a lot of focus on your feasibility study. You got to work with guys like Barry, your boss, who have been in the business, who understand the dynamics of the submarket, spending a lot of time there, understanding that, rental rates are hard to pin down right now with the heavy discounting that are going in right now. It's really, really hard to develop to what people are quote unquote the street rates. And so I think you just got to be very, very selective on your sites. You got to take time. You got to be patient. That's the other thing is, I see developers all the time. They buy a site, they get the entitlements, and they want to go. And sometimes it pays to wait, 6 months, 12 months, 18 months. I know it's not ideal from a return standpoint, but I think, it'll pay huge dividends long term to just make sure you understand the rental rates, you understand the supply demand metrics within the submarket, and really understand that it's a 3 to 5 mile radius. It's not a 10, 15 mile radius. And I think you got to look and see, even if, and sometimes you got to look out 15 miles, because if somebody's building one to the north of you that's 7 miles, that's right outside your trade area, he's going to take some of that trade area from you. So I just think spending a lot of time on your due diligence, and really understanding that nobody pays more because it's nicer in storage. I'm a firm believer that you don't need to build the Taj Mahal when you develop self-storage. You need to build facilities that are clean, safe, and friendly. And I think that, because let's face it, this is a need-based business. A 10 by 10 is a 10 by 10. And we just got to make sure that you really spend a lot of time on your budget and your construction cost, and most importantly, just the supply demand metrics within your submarket. But, I can't tell you how many social media posts and other type of posts I see out there from people raising money for self-storage development or investments that, quite frankly, don't have any business doing it because they're just not doing any justice by their investors.
Ben Vestal, I cannot thank you enough. I kept you over. I'm already 4 minutes over my 30-minute timeline. I couldn't stop asking you questions. Somebody wants to get a hold of you on the Argus Storage Advisors side. They want your insight if they're looking at a facility, maybe want your help finding a facility, or on the third-party management side, you guys still heavily involved with SmartStop. How does someone get a hold of you and be able to set up some time?
Feel free to send me an email at bvestal@argus-realestate.com. And I'm probably a little unique in the fact that I have no problem you calling me on my cell phone, even if I don't know you. I truly enjoy talking self storage with anybody. And my cell phone's 303-717-3400. You can call me anytime. For better or worse. Self storage is my passion. It's my hobby. A lot of guys start playing golf and fishing and all as they get older. I just keep showing up to work and doing my job, and I really enjoy it. You can call me anytime. I love talking self-storage with anybody and would be happy to talk to anybody that wants to talk about it.
That was my mistake. I kept trying to talk to you about coming on the podcast. I should have just called you to talk about storage. I would have gotten a hold of you a lot easier.
Yeah, I mean, I know it's weird. I love talking storage, man. That's what we do.
He's Ben Vestal, CEO of Argus Storage Advisors, now part of the combined SmartStop and Argus Professional Storage Management. Can't thank you enough for your time, man. What an incredible half hour talking about self-storage. That's it for this week's edition of the Stories Behind the Door podcast. We'll see you next week.
Thank you, guys. Thanks, Thaddeus.